Hi everybody. Today I want to talk about leading indicators, KPIs. I know if you're a busy sales manager, it's probably something you hear over and over again. Your boss is asking for them, your company is asking for them, and you're like bogged down in KPIs. So let me make it simple for you. There are two types of KPIs that exist as far as I'm concerned. Number one is leading indicators, and by the way, KPI stands for Key Performance Indicators. I'm sure you knew that, but I just wanted to make sure. Number two are lagging indicators. So lagging indicators are indicators that measure things after the fact. That's why it's lagging, like revenue, profit, things that have already happened. VPs of sales don't really need to pay too much attention to that because there's not much they can do after the fact. So what most good VPs of sales care about the most are leading indicators. What does that do? Predicts the future. You want something that's going to predict future revenue. So performance that your sales team is engaged in that's going to provide the results you want. Predicting the future. Here at Criteria for Success, we believe we've invented a great crystal ball. We call it the deal email. It's the best leading indicator of future business. Let me explain. Many organizations, many VPs of sales measure number of phone calls, number of meetings as leading indicators for future sales. The problem with that is that you've probably been aware that some salespeople can make 100 phone calls and get 0 appointments, and some other salespeople can make a lot less phone calls and get more appointments. So phone calls to appointments don't always equate. The other problem with that is that you can game the system. I can call if I'm a salesperson and wish someone a happy birthday, and I'm going to check the box that that was a phone call. Same thing with meetings. I can jump in on someone on the street and have a conversation, check that box, that was a meeting. So meetings to business doesn't always equate either. However, using a follow-up email after you've had a meeting on a bona fide opportunity and logging that, meaning you send a prospect an email. We have a whole format, I'm not going to get into that right now, but sending a follow-up email and BCCing an inbox in your organization. We happen to recommend that you create a new inbox called deal@yourcompanyname.com. You BCC that after you've sent one of these emails, you being a salesperson. If everybody on your team, every salesperson that has sent one of these deal emails on your team is BCCing that inbox, then the job is where the crystal ball comes into it, of somebody is to tally the number of those emails that went out, say, on a monthly basis. So if, for example, in the month of January, your team sent out 50 deal emails, and in the month of February they sent out 75 of those emails, chances are very strongly that business is going to be going up, because you wouldn't have sent one of those emails if you weren't predicting or you weren't engaged in some real bona fide business. So can you see that meetings and phone calls really don't relate to future business, but follow-up emails do? If you want information about the email itself and this whole construct that I'm talking about, in the notes below this video, there'll be a link to a resource on criteriaforsuccess.com's resource page that you can download. It's an ebook and it'll explain it in detail. Hopefully that was helpful. Please don't forget to subscribe to our YouTube channel, and good selling out there.